Exit poll results over the weekend mean that we're going to start, according to the GIFT Nifty, with a 3% pop.
The results are clearly showing that there's going to be policy continuity.
On the capex theme, we went bullish about 3 years back.
Who cares whether it's 340 or 260, as long as it is more than 272.
Important thing is to understand that this is an absolutely unprecedented time.
Markets are trading, and the verdict is clear. It's a new all-time high, 23,300 plus.
People are sitting on cash, or people are waiting to deploy. How do you do it?
And the bulk of those gains are still intact. That's the headline at 11 a.m. Hello and welcome to Trading Hour. I'm Surabhi Upadhyay. With me, as always, is Reema Tendulkar, and that vibrant-looking green screen reflecting the enthusiasm from those exit polls is still retaining a lot of those gains. Reema, hi.
Hi, and leadership is still very much intact, right? The leaders over the last, maybe 2 years or what have been the Adani Group stocks, the PSUs, the infrastructure-led names, and that's where bulk of the gains are coming through. So pull up the Nifty, the top Nifty gainers. Right on top, you've got Adani Ports, Power Grid, NTPC, BPCL, and these are stocks which have led the rally today and so far in 2024. And even if you go back 1 year, 2 years, 3 years down the line, that's where the gains are concentrated. Even on the mid-cap end of trade, it's the likes of Adani Power, IRB, BEL, so the defense, the railway, the power theme. These are stocks which are doing very well. And look at names like Cochin Shipyard, right? 200% in 2024 itself, Surabhi. It's absolutely mind-boggling.
Absolutely. And if you look at a one-year chart of Cochin Shipyard, then it'll literally blow the lights away, right? Because we're talking 700, 800% sort of gains. Anyway, just to talk about the sectoral move, so everything economy is basically moving higher, but within that, what's doing the best? So, of course, the PSU space, the Nifty, PSC and CPSC indices, they're soaring even now 6 to 7% higher. Energy, oil and gas, infrastructure, all of these, individual pockets, along with oil and gas, all of these individual Nifty indices are the poster childs of this move, so to speak, all of them doing very, very well. If I talk about the non-Nifty movers, because I was trying to, non-PSU movers, I tried pulling out some names there. Shriram Finance on the index, L&T, and Mahindra, definitely, they deserve a mention. Interestingly, Mahindra & Mahindra obviously not reacting to the monthly sales data, which is actually a little patchy. This is about big picture economy moves and M&M symbolizing a stock like that or a theme like that. Then there's Reliance, which is obviously contributing almost 4% higher. And Axis Bank and IndusInd Bank are doing very well as well, which brings me to banks, because the Nifty Bank is actually looking smarter than the Nifty even now, with a gain of in excess of 3% odd. In fact, speaking of banks, who better than the biggest banker of the country to join in on what is indeed a very historic day for the markets? We do have Mr. Khara joining in. We have Lata to take the conversation forward as well. And Lata, it's over to you for that.
Thanks a lot, Surabhi. And thank you, Mr. Khara, for stealing time for us from your various investor meetings in the Bank of America. And my thanks to the Bank of America India team as well to permit this interview. Good morning to you, sir. Your first thoughts on the way in which the GDP numbers have come, as well as the fiscal deficit. Do you know that the PSU stocks are the toast of the market today, all up between 6 and 9%? So your first reaction to the GDP numbers and the fiscal deficit number?
No, I think it is quite encouraging to see the kind of GDP numbers which have been seen. But of course, it is all attributed to the kind of initiatives which have been taken for past couple of years. And actually, among all the uncertainties which are seen across the globe, Indian economy is standing tall, and thanks to the initiatives which have been taken over the years. I would say that this is very encouraging, and this very clearly augurs well in terms of our trajectory going forward too, in terms of the GDP growth numbers.
Actually, you've put your finger on what I should have asked you first. The political continuity that is looking more guaranteed. As you say, it is policy that enabled the kind of growth. And therefore, the next question. Since political continuity is assured at this point in time, what are you expecting? I mean, what would be the top 3 or top 5 things that you expect is going to come with the new government?
I think with the continuity of the progressive policies, it will be the right environment for the Indian economy to attract investment from across the globe. Apart from that, the investments which are on the drawing board, they will get to see those investments getting fructified. So ideally speaking, it is going to be a very high economic activity which I expect to see going forward.
Do you expect as a banker to lend more to infrastructure, real estate, capex? As a banker, how are you approaching the coming political economy scenario?
No, we are quite hopeful. Yeah, this is going to unfold opportunities, and the opportunities which will meet our risk appetite. We will be more than happy to support all such initiatives, and that we have been doing in the past and we will continue to do going forward too.
I'm sure you're privy to some policy initiatives, some PLI, some sector. No, Mr. Khara?
No, I'm not
Okay.
privy to any such thing.
Okay, well, let me come to banking sector proper or to SBI proper. Bond yields are falling. They went even below 7% a few days back. The fiscal deficit is likely to be lower, going by the number that was announced on May 31st. Last year's fiscal deficit is 5.6, not 5.8. Now the RBI dividend gets factored in. So it's possible that the bond issuance itself by the government is going to be less. Do you think your NIMs have a very good chance to rise because of, income coming from various sources for you?
This of course reflected to NIM. Our effort will be to see that whatever improvement we can achieve in the NIM, we'll certainly do that. So, but yes, of course, it keeps on evolving. There are multiple factors which have an impact on the NIM. But yes, of course, what you mentioned in terms of the bond yield coming down, lowering down. So that is something which will certainly have a positive impact for a bank like us.
Okay. Are you likely to borrow globally? S&P has pushed up a positive outlook even on the banks because following the sovereign positive outlook.
Yeah. Yes. No, in fact, we do have about 12% of our overseas balance sheet is actually from the international banking group. Okay. And there we do keep on borrowing, and it will certainly impact our borrowing costs also for supporting that book. And whatever positive we can generate out of that will certainly show up in our results.
Okay. Now, don't kill me, but we have to ask you about this because the speculation keeps coming in. Will you tweak your holding in Yes Bank?
We will have to wait and watch to answer you this question.
Okay. It's not a perfect no and not a perfect yes. So that's very important. Mr. Khara, as well from the Reserve Bank, any expectations of rate cut? When are you penciling it in? Do you see a cut probably in the next policy, if not the immediate one?
Well, my sense is that when it comes to the interest rate cut from RBI, it will be a function of the inflation trajectory. And the way it is evolving, it appears that maybe in the quarter commencing from October, maybe there could be some kind of interest rate cut.
Okay. Are you getting the sense that your credit growth may be higher in FY25? Would you want to up your number? Your entire investor community is listening to you today. Everybody is glued to markets. Would you up your credit growth forecasts?
No, in fact, as of now also, we have got our loan to deposit ratio, which is about 68-69%. So there is enough elbow room for us to step up our credit, but we are always mindful that we should underwrite credit which suits our risk appetite, and we should have enough mitigants in place if at all there is a risk which is seen in a particular credit proposal. So that's the philosophy which we are practicing, and we'll continue to practice that. And if at all there are decent opportunities in the market, we'll certainly be there to tap those markets, those opportunities also.
Okay. As an SBI banker, or as the country's biggest banker, what do you want from the new government?
The progressive economic policies.
You should give me some more details, just not one adjective. Is there any expectation in terms of, a PLI, tax incentives, anything specific that you are wanting to hear or you are expecting to hear?
No, I think I accept that the policies are the boundary conditions in which we have to operate. So, as a disciplined banker, we respect the boundaries and we would like to operate within the given boundaries. But yes, of course, if at all economic environment is positive, it certainly unfolds opportunities which are quite bankable.
Okay. All right, Mr. Khara, we'll leave it at that. And thank you very much for trying to squeeze time between your investor conferences and presentations for CNBC TV18. Thank you very much indeed for joining us.
Thanks, Lata. Thank you very much.
Okay, so I think the answer to the Yes Bank question was more iffy. We will have to see. It wasn't that no, we will not change our stake. I think that will be important. But more than that, I think they're quite positive on the fact that they will make more money on bonds. The way in which lower fiscal deficit, rating agency upgrade, bonding index inclusion. All this is very positive for PSU banks, and I think that's what the screen is also telling us.
Oh, absolutely. The Nifty bank is up 3%, while the PSU banking index is up close to about 5%. As one of the brokerages also said, they prefer PSU banks to private banks because this government's agenda for affordable homes for all, could benefit the PSU banks more than the private sector. I think it was Nomura which highlighted this. We will slip into a very short break and continue talking about banks because the Nifty bank has hit a new all-time high and a milestone of 50,000 today. Hormus will get us a complete timeline on the other side.
All right, welcome back. Let's now get you some big market opinion. We've been speaking to a whole host of voices after those exit poll results to figure out where the market could be heading after we get the final election outcome. Listen in.
I think it won't matter beyond maybe plus minus 0.5%. Because the market's main interest was that the same management is there, that sort of the same policies are there, the same thrust is there. Most of the ministers are the same, the railway minister, this minister, the oil and gas ministers.
So he has set a goal of 400, up ki bar 400 par. So if by chance actually this happens, all the short sellers, and I think the mood of the nation, and this is one election which is being watched all over the world. It's not only about what we are going to do. So this is a proper global event right now. And these things will sink very slowly. And we should not forget other things are also happening in the sense that your GDP numbers just came day before or something like that, which is way beyond almost 100 basis point higher than what the economists were saying. So a lot of things are coming together to say that this party which is starting with declaration of result is not going to be over just in a day or two. There could be correction, there could be selling by FIs, whatever. But I think it's a much longer party and larger party. I mean, larger for longer kind of party it is.
So I think there is a significant opportunity for wealth creation over the next 5 to 10 years. That if you are willing to take, because you are late in the party, if you're a new buyer, if you're an old buyer, the choice is very clear that you have to be staying with the market, and you have to staying with your portfolio, you have to staying with your investment. But if you're a new buyer and wanting to put new money in the market, then, if you look at immediate making money, that is going to be tough because you are coming at 23,000 Nifty, and that's not going to be easy. So if you look at next 3 years, if you start to look at 2026-27 from earning perspective, then you can find a lot of investable ideas. One, financial sector clearly looks like a very, very good risk reward from my perspective.
Going forward, next 5 years, when we look at if the economic growth continues to be in high single digit in real terms, call it 6 to 8%, and nominal GDP is in low double digits, profit cycle is on the up move, you should have base case low double digit, call it 11-12% kind of earnings growth. And if the profit cycle gains further momentum, we can approach mid-teens, in which case earnings can double over the next 5 years, and markets, if it remains where it is in terms of multiples, which while higher than most of the world, it is not unusual, it is not uncharacteristic of what India has been historically. And so we can see a market again, approaching a double over the next 5 years.
Okay, let's get to the big story then, and that's the Nifty Bank, which has hit a new milestone of 50,000. Hormus is now joining in. He's at the big wall. He's going to take a look back at the Nifty Bank's journey to 50,000 and the big contributors to this rise. Hormus, over to you.
Well, it should have happened a month earlier, but as they say, better late than never. We fell short by 25 points in April, but we finally managed to cross that mark of 50,000 on the Nifty Bank after the exit poll outcome. And it's been quite a journey since 2017 when the Nifty Bank had first hit the mark of 25,000. And since then, the index has doubled in the last 6.5 years. And if you can put up the milestones as well, from 25,000 to 30,000 and 35,000, now we eventually stand at 50,000. There you can see that 27th of July 2017 is when we hit 25,000. Since then, it was a bit of a lull. After that, we had to wait almost a year and a half before we hit 30,000, which was on the 22nd of March 2019. And then another 5,000 points took another almost 2 years. We hit the 35,000 mark on the 4th of February 2021. That is after we dipped to the lows of COVID and then recovered from there. 40,000 happened on October of 2021, and now almost 2.5 years later, in June of 2024, we have finally hit 50,000. So which are the stocks that have led this rally? And ICICI Bank from July of 2017 is the top performer on the Nifty Bank when it comes to their 265% on ICICI Bank. SBI is their second best performer. Their AU Small Finance Bank is a recent inclusion in the Nifty Bank. That is also up 124% since July of 2017. The index heavyweights are also part of this. HDFC Bank is also part of this list, 71% for HDFC Bank. Axis Bank is another one that doubled in this period from 25 to 50,000, and Bank of Baroda is up 68% as well during this period. But there are underperformers as well in this rally on the Nifty Bank, and IndusInd Bank is one of them, 9% lower during this period. PNB is down 16%, and Bandhan Bank has halved from those levels. But Bandhan Bank, remember, listed in 2018, and since then the stock has halved. Now the point contributors, ICICI Bank being the top performer, it's an index heavyweight as well, so it has an equal proportion when it comes to the percentage of the rally on the Nifty Bank. Almost 40% of that rally on the Nifty Bank has come from ICICI Bank. HDFC Bank, SBI, Axis and Kotak form the remainder of the gainers. Now I mentioned Nifty Bank hitting 40,000 in October of 2021, and since then it's been the rise of the PSU banks, and they have been one-way traffic for them. As you can see, Bank of Baroda has almost tripled from October of 2021. PNB has almost tripled. PNB, being an underperformer since 2017, is an outperformer when we take returns from October of 2021. Federal Bank also forms a mention. They're 75% higher on that stock since October of 2021. When we take a look at the other gainers since that period, and you would find SBI there as well, 70%, and IDFC First, 57%. The underperformers, well, private banks were underperformers, and HDFC Bank is part of this list, 9.5% lower since October of 2021. Kotak Bank and Bandhan Bank, of course, part of this list. Now, when we bring up the point contributors for that period as well, you would find that PSU banks there in that, but ICICI Bank continues to remain the dominant player there as well, although it's not among the top gainers. But considering the weightage that it has on the index, 45% of that rally has come from ICICI Bank. SBI, Axis, Bank of Baroda and PNB completing that point contributors, the top contributors to the Nifty Bank. So the landmark is finally achieved. It's been an equal mix of both private and PSU banks across various periods. The market is cheering this move. Back to you.
Okay, Horma. So not sure about 400, but ab ki baar 50,000 ke par. That has finally happened for the Nifty Bank. Got it. Thank you so much for that interesting compilation. We do have to take a break on that note. Come back on the other side and we'll get you a couple of trading calls. Soni Patnaik of JM Financial Services will join in. Welcome back to Trading Hour. Let's go on and talk about the commodity market cues that we're getting. We have Manisha joining in with the action. Manisha, we've got plenty going on in our markets, but you tell us what are the commodity cues like today?
Oh, well, yes, the exit polls are something that's keeping all of us busy, but internationally as well, it is about the economic data that has come in from Asia, which is on the positive side, and that is keeping commodities in good favor right now. So you have the China PMI, which is expanded at the fastest pace in 2 years. We also saw South Korea manufacturing activity, which was the best in 3 years. So there are better, stronger numbers coming in from Asia, especially China, where we also have seen 3 or 4 stimulus measures being put out from China. That seems to be showing its impact on the numbers here as well. I want to start with China stimulus numbers itself, first of all, and we've seen 1 trillion yuan being pushed. It's also about easing mortgage rules, and also the local governments have been told to buy apartments to ensure that the overhangs are cleared a bit. So there is this thrust on, sector like infrastructure and housing and property, which is supportive for metal prices, is exactly what we've seen coming in. After a strong April and a May, the June month also has started on a positive note. So many of these metals are trading in the positive right now. For copper as well, we are up 20% in this year until now. And the markets have seen an all-time high. There are expectations of supply concerns going forward from here. The investment in metal mining has been on the lower side. And that tells you that going forward, as and when the demand starts to pick up very strongly, there's not going to be enough supply to match demand. And that is keeping the prices in premium right now. Same is the case with energy markets as well. While the month of May wasn't so great, we saw 6 to 7% of decline in the crude prices in the previous month. But the crude prices also seem to be taking favor right now from strong Asian data. And then OPEC and allies as well have continued to cut production going forward until the month of September. And the larger production cut of 3.6 million barrels is expected to be extended until 2025. And so as and when the demand comes back, you would be looking at support coming in here as well. So both of these sectors really trading on the higher side of the range as we open Asia on a newer week.
Thank you very much for that. Soni Patnaik from JM Financial Services is with us on the show. Soni, morning. We had a big gap up opening and we've held on to those gains. So the Nifty is up 650 points. Sensex is up more than 2,000 points. The question is, do you chase the gap up from here on? And what would be the stocks that you would bet on?
Good morning, Rima and Surbi. Thank you so much for having me on this show. So I think if we talk about Nifty and Bank Nifty, both the indices have crossed par the resistances with the help of exit polls. And current level, if we see, Nifty is adding fresh longs today of only 2%, which is indicating that 23,000 can become your near-term support. And as long as the support is getting held, it has a chance to test 23,500. So 23,500 is actually the level where Nifty can face a resistance. There was a lot of call writing prior to this week and it has been continuing. So I think that's a level where there could be some hurdle for Nifty, some profit booking that can be seen from 23,500 levels. And from there on, the range can become a 23,000 to 23,500. Similar for Bank Nifty today. Bank Nifty today is adding 4% of fresh longs today. So I think that's quite significant for Bank Nifty. So if you look at Bank Nifty, there's more momentum and space left for Bank Nifty to test 51,500 plus levels from current level. I think that's very important because there could be a lot of parameters for Bank Nifty that can support. So I think PSU banks, private banks such as HDFC and Axis Bank can support Bank Nifty to test 51,500 from current levels. I think that's the level to watch out for when it comes to the indices.
Okay, and Soni, apart from the indices, any other interesting stocks that you have your eye on that you're trading?
Definitely, so the first would be from the finance space. Muthoot Finance, we're seeing a good, bullish engulfing candle pattern today, and there's a good intraday breakout on charts. So Muthoot Finance can be bought from current levels, keeping a stop loss of 1,700, and a target of 1,800, 1,820 can be seen in the near term. The second stock pick is United Phosphorus Limited, UPL. It's also looking quite strong. It has been sustaining above 500 level, which is a very good support now. So keeping a stop loss of 505, a target of 550 levels can be seen.
Thank you very much for that. We'll slip into a break. On the other side, we'll be joined by Candice Browning, Head of Global Research at Bank of America, from the sidelines of their India Conference 2024.
Welcome back. Well, let's move on to our next guest. And we have with us Candice Browning, Head of Global Research at Bank of America. And actually, Candace is with Nigel, who is, of course, been camped at the conference right from the morning, picking up all the action over there. Nigel, what's happening?
Well, thanks a lot for that, Surbhi. Well, Candace, always a pleasure talking to you. Thanks a lot for joining in here on CNBC-TV18, and congratulations on the conference as well.
Thank you.
You know, since it's an election year, both here in India as well as the United States, the stock market seems to be a little bit skittish. But data points prove, or history proves, that actually equity markets do quite well in election years. Tell us more about that statistic.
Yeah, that's absolutely true. On average, if you go back in the U.S. over multiple elections, the market is typically up 11% on average during an election. There can be a lot of volatility, but typically the market is up.
Okay, all right. So U.S. markets, in fact, they do well in an election year, which is quite interesting. Tell us, do you have a level on the U.S. markets? Because the mother market has been doing well, and that obviously helps an emerging market like India when you have some stability out there. But do you have a level on the S&P 500?
Yeah, on the S&P 500, we're looking for 5,400. So, sort of very modest upside from here. I do expect that there will be some volatility.
Okay.
In fact, if you look at it on average in each year, there's about a 5% down movement. So I expect there will be volatility, particularly in an election year.
Right.
But we're looking for 5,400, and that's really driven by earnings, because it's earnings and profits that drive stocks, at least in the United States, not elections.
Indeed. Since we're talking about the United States, what stands out is the kind of move you're seeing, the Magnificent Seven. And NVIDIA has been in a world of its own. In the last, if you plot a 1-month chart, a 1-year chart, or an 18-month chart, that stock has been on fire. So tell us about, how do you see the Magnificent Seven pan out, as well as a quick comment on NVIDIA.
So basically, if you look at the Magnificent Seven, they are 7 disparate companies. And in fact, we at Bank of America, coined the term, the Magnificent Seven. So what you're seeing is that if you go back to last year, you saw the earnings growth of the Magnificent Seven was dramatically higher than the rest of the market. But what you're going to see going forward, and you've already started to see, is that those two earnings growth ratios are coming together. And by the fourth quarter of this year, we think the Magnificent Seven earnings growth will be about 15%, and the 493 will be 14%.
Oh, okay.
And so we really think there's going to be this broadening out of the market to the 493.
Right.
We still have a buy on NVIDIA. We recently raised our price target on it. We see great things ahead for NVIDIA.
Okay, so the U.S. market seems to be in a good space as of now. But let's come back home to India, and let's talk about the emerging markets. There's been that toss-up between India and China. And I think y'all had a tactical call that China will do well in the last few months, from January onwards, if I'm not mistaken. What's the call right now? Because India's got some political stability, earnings, as you said. That's the fundamental driver for markets ultimately. Stability, policy continuity, and we seem to be in a sweet spot. How do you all toss up the two now between India as well as China?
Well, basically, as you said, we think tactically that there's some reasons to be constructive on China. If you look at, as a matter of fact, in January, pessimism about China reached the highest level ever.
Okay.
And then after that, we started to see some reforms. We've started to see, some better economic data come through. So we're constructive on China in the short term, but in the longer term, we very much prefer India because of the demographics, because of that they're just beginning the growth cycle that China started, decades ago.
Yes.
There's a whole host of reasons why we're more positive on India longer term than China. And on emerging markets overall, I would say that if we have a soft landing in the U.S., that means we're going to have a takeoff for emerging markets.
Okay. Since we're talking about China, what's happened with China, the policy measures we've been getting from the government out there, as well as the central bank, is that commodity prices have moved up. At some point of time, that could be a bit of a risk for this, this inflation cooling off. How are you all placed on commodities, if you could comment on that? And given inflation could again, perk up a little bit, what are you all factoring in terms of Fed action for this year itself?
So basically, as it relates to commodities, on the energy side, we think the demand has been a little bit weak, and the energy prices have been, largely driven by geopolitical concerns. And remember, the United States is energy independent, right? And so energy, we're not really concerned about. But copper and other base metals, we do see a very large demand for those base metals, particularly as we go through the green revolution, AI, et cetera. We need all of those metals to fuel that revolution. And as it relates to the Fed, what we're looking for there is we're looking for the first cut to happen in December.
Okay.
And then we're looking for 4 more cuts next year, and we think we'll probably end with the terminal rate in 2026 of about 3.75%. Now, the risk is because, we've all been waiting for these Fed cuts all year. But obviously, the risk is that inflation comes in even hotter and the Fed doesn't cut at all.
Oh, all right. And you're penciling in a first cut in December itself,
yes.
Right? We started this year thinking that maybe March you get an outside chance that you get a cut. Then we said maybe in the middle of the year, September, but you're saying maybe December. And the risk is maybe we don't see one.
Well, one of the reasons is because the U.S. consumer has been so much stronger than anyone predicted. The U.S., the great preponderance of mortgages in the United States are fixed rate.
Right.
So if you have a fixed rate mortgage and you don't have very much credit card debt, inflation really doesn't impact you very much.
Right.
So we've seen the U.S. consumer, not be impacted by rising rates. Plus, we've seen good growth in wages and a very solid job market. So the U.S. consumer has held up very, very well.
Indeed. And just to get done with the word on commodities, and then I think my co-anchors would want to ask you a couple of questions. Copper is something you're still bullish on. And what about gold?
We're bullish on both copper and on gold. Copper really is a function of, the change to EVs, and gold really is a function of the central banks wanting to diversify away from the U.S. dollar.
Okay, all right. Well, I think Surbhi and Rima want to come in as well. Go ahead.
Yeah. Thanks for that, Nigel. I just have one quick question for Candence. Great listening to you, Candence, and appreciate you being with us. So at 5,400 on the S&P 500, you're not expecting much of an upside, in the U.S. market. And the other point you made is extremely important as well. Convergence of the earnings of the Magnificent Seven with the rest of the market. So are you predicting a scenario where perhaps returns start flattening out for the U.S. market? And if that were to be the case, can we expect more foreign flows here in India? Because foreign flows have actually been absent. This is a domestic-led rally here so far this year.
Well, yes, and that's kind of what I was trying to say before when I basically said that if you get a soft landing in the United States and earnings growth and GDP growth in the United States moderates, that means that there will be a pickup in growth in emerging markets. So yes, I think that would be very positive, for example, for India, which is our favorite pick among the EMs.
Candice, morning. So the FPI holding in India is the lowest that we've seen in the last, in over a decade now, despite India being a favorite over the longer term. Do you see that reversing anytime soon?
That's hard for me to predict, to be quite frank. It depends on a lot of different factors. Certainly it should, but it depends on a lot of different factors, so it's a hard one to call.
Candence, if at all you've looked at this market in any more detail, since this is your top emerging market pick, what do you like here? I mean, some of the manufacturing themes, capital expenditure, those stocks have run a lot in the country, but do you still like them?
So when we look at stocks over, a 1 to 5 year period, and we love the long-term setup in India with the demographics that you have here, with the pro-growth government. We like all of the long-term setup in India very, very much. Plus, remember, while India is very expensive, emerging markets overall are not particularly expensive. If you look at the U.S. market, it's trading at 21 times. The rest of the world is trading at 14 times. Well, yes, India is relatively expensive, but it's also the largest economy that's growing this rapidly and likely to do so for the next 5 to 10 years.
All right, Candice, it's been a pleasure hearing your thoughts. We've taken note of all the points you made. U.S. markets normally do well in election year. India, well, it's a structurally good story. Earnings ultimately will drive performance. And in terms of commodities, gold as well as copper, those two you're bullish on. Wishing you a good conference, and thanks a lot for speaking to us here at CNBC-TV18.
Thank you, Nigel.
Well, back to you all in the studio.
Okay, Nigel, thanks very much for getting us that conversation. Do have to take a quick break on that note. Come back on the other side, and we'll have Sachindra Nath from UGro Capital to take a few questions about the business at the end of the fourth quarter.
Welcome back. It's been a very, very steady morning. We had a big gap up opening and the Nifty's held on to all those levels. It's now approaching a 3% rally on the Nifty and the Sensex. Strong advance decline ratio. And once again, it's the defense, the capital goods, the PSU, the railway stocks, shipyard stocks, which are leading the gains. I think the only now worry in the market is on the valuations, because this is a very interesting table that, I pulled up from Kotak Institutional Equities on the valuations of these stocks, where they were just prior to COVID and how they've gotten re-rated in the last couple of months. So ABB, for instance, is now approaching 100 PE, as we've been talking about. BEL, from a PE of 13x, is 36x. BHEL, Cochin Shipyard, are now approaching a PE of 75, 80 times. And the list goes on. Even the second plate will show you for Cummins, Dixon, Thermax. The PE re-rating has been enormous in the last couple of years. So is that a bit of a risk? Are these valuation multiples comfortable at current levels, or is there a bit of a bubble territory in that? And I think that's the big concern in the market now. But but the stocks continue to do well. So for instance, ABB is still up close to about 5%. Dixon is up close to about 3.5%. Siemens has moved up to a near 5% rally. Just wanted to highlight that. But also let's get you some important market opinion. Earlier today, we had a chat with Matt Orton from Raymond James Investment. Listen in.
Particularly, you're seeing a lot of the CapEx-related names, a lot of the infrastructure-related names making particularly large moves pre-market. And I think that's where I'm most optimistic about India right now, is on the infrastructure play. We've talked about that in the past, but I think it signals that there's a lot of opportunity moving ahead in that part of the market. The companies that generally support power build-out, so Adani Power, Tata Power, I think all of that makes a lot of sense to look into. Larsen & Toubro is probably my favorite name in the space because of its broad exposure to the infrastructure theme. And even a name we've talked about a lot, which is in autos, Mahindra & Mahindra, they're not just exposed to the consumer and a lot of new product launches, but the Mahindra Group in totality has a lot of exposure to the India growth theme. The results are clearly showing that there's going to be policy continuity. I think that's what the market may have been reacting to with some of the volatility over the past few weeks. So getting that clarity moving forward, I think, is very important. And you'll see a rotation out of China, the fast money moving out of China and coming back to India. And I think that can be stickier now that we're through this event.
Okay, let's move on now and invite the management of UGro Capital. They've seen strong AUM growth in the quarter gone by. The operating profit, along with the profit after tax, has also gone up on a year-on-year basis. To discuss these numbers, we have with us Sachindra Nath, the founder and managing director at UGro Capital. Thank you very much for joining in. There is some concern about stress emerging in the MFI industry at large. I'm not talking about your company in particular, but in the industry, inflation is hurting the rural markets. There is distress. And the worry is that maybe collections will dip in FY25. So as we begin this new fiscal year, what can you guide in terms of the AUM growth, in terms of what the credit cost is going to be, what the asset quality is going to be for your company?
Yeah, as far as UGro is concerned, as you know, we are India's dedicated MSME financing company. Our target customer segment are custom businesses which are between the trading turnover of 15 lakh to 15 crore. We continue to believe that the level of digitization and formalization happening for this segment of the market of MSME is very, very strong. The adoption of GST, the digitization, and the resilience is very strong. So we continue to believe not only the credit gap continues to be very, very large, 90 lakh plus crore, and this is 90% of that credit gap belongs to this customer segment. We are quite bullish. Our infrastructure is very strong. Last 3 years, we have added almost 3,000 odd crore of AUM to our book. We continue to believe that we are now expanding our micro network from 100 location. We are now going to 250 plus location this year, 400 location next year. So AUM growth may be in the same range, but our return on asset would move in next 8 to 9 quarters from 2.5% to almost 4%, and so as return on equity. What we are also seeing is the co-lending, because there is a general belief that bank lending to NBFC is slowing down. But for NBFC, which are focused on MSME, that is not true. And also, we are seeing a renewed level of interest from multiple bank and now even private sector bank to partner with us. So the co-lending or off-balance sheet, which is currently at 47%, would go up to 50-odd%, which is our target, which will improve our ROEs as well. So overall, we are very, very bullish. We think that policy continuity and the same government coming back, and given that this government has focused very heavily on MSME, even if you look at their what they have said with respect to Mudra and other loans, I think the MSME economy would do fairly well.
So you had about a 49% AUM growth last year in FY24. Will you be able to sustain that kind of a run rate? Because you've done some fundraise too.
We have not done some fundraise at a capital of 1,450 crore. We did almost 1,330 crore of new equity capital. It was a very large capital which we raised. For the first time, as you know, we are for India's first listed startup. We raised almost 950 crore from 4P investors in 2018. Then we raised 340 crore from Denmark government IFU in 2023. And we have now done a CCD plus warrant wherein one of our existing investors put 500 crore and diversified set of large family offices in India put capital into this. So our capital base is ready or support our growth for next 2.5 years very easily. So as I said that in percentage term, not in percentage term, but we would add more than 3,000 crore what we have added in last 3 years. But the incremental addition to our AUM is on a higher yielding side. So all of our incremental AUM is in the range of 18 to 20% yield, which is coming from our micro enterprises segment. And that is what would push our blended portfolio yield by 150 basis point in 8 to 9 quarters, would increase our ROA by almost 150 basis point.
Okay. So some sense on how much you're expecting to grow the book? I mean, you're at about 9,000 crores right now, Mr. Nath. So if you could give us some guidance, I mean, what's the target for this year and maybe a roadmap for the next 2-3 years?
Yes. So as I was saying that our base capacity is to grow by 3,000 crore every year. Given that we are now adding almost 150 plus location this year, the 3,000 crore should be higher. So we should be in the range of 13,000-14,000 crore. And our target to end 26 with our aspirational number of somewhere near about 20,000 crore, we still continue to hold on to that. This is a function of the liability flow more or less. Our base infrastructure on asset side is very, very robust. But as you know, we are dependent upon overall liability flow. So because the bank lending to NBFC have slowed down, RBI have raised concern, not with us, but overall bank lending to NBFC. Fortunately for us, because we have a diversified liability side, we continue to maintain the same growth level. But we continue to believe that in 6 to 8 months' time, this flow of liability would increase, and so as increase will our AUM.
Yeah, good you brought up that point because we wanted to understand how cost of funds is moving. Right now, our colleague tells us that I think the calculated NIM is still higher. It's higher sequentially. It's even higher year on year. If you could give us the exact number, where are you on the net interest margin at the end of Q4? And how is the cost of funds moving? What's the expectation here on NIMs?
So, this is the bridge. We are saying or we are guiding that in 8 to 9 quarters, from a 2.5% return on asset, we should, because our base OPEX is all built out, we should be at a 4% return on asset. We are expecting 150 basis point portfolio yield increase. We are expecting 75 basis point cost of borrowing go down. We are expecting our credit cost to go up by half a basis point just because of the portfolio maturity, and a half a basis point of our OPEX, to income ratio or, operating leverage would come. So we are expecting both because of our size, vintage, our cost of borrowing, and also hopefully the cycle would change, our cost of borrowing to go down by at least 75 basis point sequentially in few quarters.
I mean, net interest margin at 9%, 9.5%. Can you give us a band?
Yes, so I think the calculation of NIM in our case is little, tricky because half of our income comes from the co-lending. So which is not doesn't show up in the net interest margin. It comes as a fees. But our NIM would improve by because our yield are increasing by 150 basis points. So our NIM should also increase by same margin.
Okay, thank you very much for joining in. By the way, the Nifty has now crossed 23,200. In the last few minutes, it's the banking names. The State Bank of India is now 895. ICICI Bank has gained 3.5%. Reliance Industries too is pushing higher with a 100-point gain right now, 2,965 on Reliance Industries. We will slip into a very short break. We'll come back with more on the markets.
Welcome back. Okay, as we're in the last leg of the show, let's also focus on some stocks that are in the news today. Ekta is tracking Aurobindo Pharma. Ekta, hi. So what's the news here?
Thanks for that. Well, it's definitely a landmark deal which Aurobindo has struck. They have announced signing of a master service agreement with the global pharma company MSD. Now, this will be to manufacture biologic products. The agreement is that Aurobindo will be building a manufacturing facility. They will be manufacturing their products and supply it to MSD. There will be an expansion of their biologics manufacturing facility in Telangana. It will also explore possibilities to enter into contract manufacturing for other biologics. This particular tie-up is expected to be only for one biologic product for MSD at this point in time, and will be both for domestic as well as international markets. We don't know whether Europe as well as US would be included in that, and what the scale-up potential of this particular tie-up would be, whether it would go beyond one biologic product or not. It is not an innovative product, but a biologic also. It's important to note that. Now, the facility will have large-scale bioreactors, and it will have an isolator line for commercial drug manufacturing of around 25 to 30 million vials per annum as well. So it is a one-of-a-kind or the first-of-a-kind contract manufacturing deal which is struck with a global pharma company by an Indian company of this particular size. It gives a sense in terms of the potential and the capabilities of an Indian pharma company getting into this space as well. Now, Macquarie has written on Aurobindo. They haven't outperformed. They've raised the target price to 13.85. They say the tie-up with MSD is a meaningful positive development both for the country as well as for the company. It is the first sizable biologic CDMO contract awarded to an Indian company by a large pharma company. Actual revenue will start flowing from CY27 onwards. They estimate a potential of 170 rupees per share from this contract. It opens up the possibility to contract with other large pharma companies in wake of the US Biosecure Act as well.
Thank you very much for that. Suzlon is also surging in trade after Morgan Stanley initiated coverage on the stock. Vivek joins in with the details. Vivek.
Well, that's right. So Suzlon is the stock in focus. A very interesting note from Morgan Stanley today. They've initiated coverage on the stock. They have an overweight rating and a target price of 58.5 rupees a share. They're saying that Suzlon 2.0, after a cleaner balance sheet, is well positioned to benefit from India's energy transition. Now, talking about the renewable energy sector, Morgan Stanley says that while India is targeting close to 500 gigawatt of renewable capacity by 2030, wind will capture almost 100 gigawatt out of the total pie. They're saying policy, regulatory framework remain quite constructive as far as the renewable energy sector is concerned. Along with that, they're saying wind energy specific is seeing a lot of sector tailwinds. They're saying that the national hydrogen mission is something that will spur demand as far as wind installation is concerned. Now, talking about the company, they're saying that the market has still not fully appreciated the growth potential that Suzlon Energy continues to have. They're expecting wind orders of close to 32 gigawatt over the next 5 years, which would amount to close to $31 billion. They're saying that the company has emerged much stronger after deleveraging and a lot leaner after cutting fixed operating costs. They're saying that the company will benefit from operating leverage levers, lower fixed costs, break-even that the company will see will be at 600 megawatt installation in turbine manufacturing. They're expecting earnings to go ahead and grow at a rate of 57% CAGR returns over FY24 to FY27. They're giving a price to earnings multiple of 35 times for, based on first half of FY27 anticipated earnings, and they're now starting to benchmark it against larger capital goods peers.
Thank you very much for that. Some other mid-caps are now moving well. Nazara Tech has a 14% gain. In the last 1 hour, Nazara Tech has added close to about 7%. PSU banks, we've been highlighting them. Bank of Baroda is up nearly 9-odd%. IOB is another smart mover. And then the infrastructure-related plays, whether it's IRB, Adani Ports, and even the financiers of power, PFC, REC, have seen some solid gains this morning in the first half. With that, we're going to wrap up on Trading Hour from the entire team. Thank you for watching. Stay tuned. Halftime Report is up next.